And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Wednesday. It's Hump Day. It is also the day before holidays. Tomorrow is Juneteenth. It's a national holiday. Juneteenth actually started in Texas in 1980. Texas made it a Texas state holiday back in 1980. Then Joe Biden converted it to a federal holiday in 2003, I believe. So it is a federal holiday. Markets are closed tomorrow. So tomorrow, I can tell you this for sure, the market will be flat. So that there will be no action in the markets tomorrow. Bitcoin will be moving around, but no action in the markets tomorrow. But today is Fed Day. So today we have the actual Federal Reserve meeting. That announcement comes out at 2 o'clock today, Central Time. So we'll get to see what the Fed says. The expectations are right now is that it'll be a nothing burger. Pretty much it'll be the same statement that we've had over the last couple of meetings, that they're concerned about tariff inflation. They're concerned about, the return of inflation. And what the Fed has gotten themselves trapped into now is this idea that inflation may come surging back, because they were wrong about inflation being transient, but they weren't really wrong, right? It just took longer than what they thought it would in order for inflation to come down. Now they've got themselves scared into this idea that inflation may come running back, and so they're not willing to cut rates here when they actually should be. The economic data is clearly slowing down. The Fed should be cutting rates here, at least modestly, to get rates more in line with where the economic growth rate and inflation rate is. So right now, the Fed rate is about twice what the inflation rate is, which really is too tight for the economy, and that's slowing the economy down more. The problem for the Fed is that's going to get them behind the curve. By the time they realize that inflation isn't coming back because of tariffs, then they're going to be forced to cut rates faster than expected. And that's going to be the problem the Fed always gets themselves into, is that despite these being very smart people, they fall victim to narratives just like everybody else. For a couple of years while inflation was high, they said, oh, inflation's transient. It was transient. It went away. It wasn't a permanent state of inflationary pressure. The problem was it just took longer for it to happen than what transient everybody thought transient mean. Everybody thought transient was going to be a month or two, that inflation was going to go away. That was never logical. But nonetheless, the Fed got tarnished by that. So now they're afraid to be wrong again. And that's always the problem. That's the same problem that traders have. I make a bad trade on a particular stock, then I won't buy that stock again because I had a bad experience with it. The Fed is getting themselves caught into that same trap right now. But again, that's just what's going on. We'll have the announcement this afternoon. All eyes are going to be on the dot plot, not so much on the statement itself, because the statement's already pretty much baked in the cake. It's the same statement we had last meeting. So the real focus is going to be on what Jerome Powell says at the conference this afternoon, the press conference, and when he gets questions, how he answers those questions. But most importantly, they'll be watching that dot plot. Now, the dot plot is the graph that you see with all the dots on it, which is just simply where each of the Fed voting members say they think rates should be. And of course, if those dots are all moving up or down, then that tells you whether or not they're more inclined to hike rates or cut rates. And it's expected right now that that's going to drop down to about one cut for the year. So it'll be on average, there'll be a few members voting for 2 cuts this year, a few members cutting for 0 cuts this year. Expectations are to be for 1 cut this year after this meeting. Again, I think that's a huge mistake, but I'm not in charge of the Fed, so it doesn't really matter what I think. But again, I do think the Fed's going to get themselves behind the curve here and then have to start cutting rates faster than they expected, because the economy is going to slow down more than anticipated. And there's a few things that are going to cause that. This newsletter this weekend, we're going to talk about oil prices in particular, because we've had 4 straight prints in a row of below inflation expectations. And of course, the inflation has been, or the expectation has been, that inflation is going to come back because of tariffs. There's been no evidence of that. but we're likely to see a stronger inflation print coming up. So here's what you need to know before the bell this morning. Oil prices on the rise here lately because of what's happening right now between Iran and Israel. And again, kind of rhetoric starting to kick up a bit. The U.S., so Israel is trying to knock out Iran's nuclear capability. However, the one nuclear facility they need to get to is buried deep within a mountain. And the only way to get to that mountain is with a bunker buster bomb. The only country that has bunker buster bombs that can reach that depth to destroy that nuclear facility is the United States. So the big threat right now is between Iran and the United States is that if we get involved, in other words, if we supply the bunker buster bomb to Israel, or if we drop the bomb ourselves to destroy that nuclear facility, which there's been some overtones from the Trump administration saying, hey, I tried to negotiate with you. We gave you a good deal to stop this, but you didn't take that deal, so consequences are coming. There is some rhetoric that is reaching up into that. Now, markets have not been paying a whole lot of attention to this lately, but oil prices, have been creeping up here. We've seen this over the last few days, in particular, as concerns over this conflict, kind of ratchet up here a bit. The Strait of Hormuz is a very big transit for oil. So if the Strait of Hormuz gets cut off, that's going to potentially cause a crimp in oil deliveries, driving the price of oil higher. And that's been one of the concerns here and why oil prices have been rising. Now, importantly, oil's at $75 a barrel. Economically, that's okay. Actually, between $70 and $80 a barrel, where we are right now, that's actually good for oil companies. It's profitable enough for them to go out and drill wells, make some money at it. But there is concern that if something happens, that we could see oil prices jump to $80, $90, $100 a barrel. At that level, everything rises in price, not just in terms of the cost of production. Yeah, I'm making more money on every dollar I produce, or every barrel I produce, but all the input costs to drilling go dramatically higher. The cost of employment and drilling rigs and all that ratchet up radically, which becomes almost non-profitable to drill even at higher prices. That's also feeding through into the economy in terms of higher oil prices, higher food prices, etc. That's where inflation can come from in terms of this issue. Now, the interesting thing about high oil prices is that it does feed through into inflation temporarily, but the cure for high oil prices is high oil prices because it crimps off demand, and then oil prices historically fall very shortly after that. So the point here is that the Fed has been concerned about inflation, from tariffs, but that's not been the case. But we may very well see a tick up in inflation in this next report because of this rise in oil prices. However, we have to keep this all into context. If you take a longer term view of oil prices, they have really not spiked that much. So we may see a small uptick in inflation because of this rise in oil prices, but this is not nearly to the degree that a lot of the media is talking about. I mean, we had oil prices near $120 a barrel back in 2022 when Russia invaded Ukraine. That was an oil price spike that could have really created a big surge in inflation at that point. But as you'll notice, that did not last long. As soon as oil prices got to that level, we had concerns about recession in the U.S. economy, and oil supply demand dropped, and that brought down prices. So again, yes, small uptick in oil prices here. That's certainly going to feed into inflation. Expect a hotter inflation print next report. That's going to potentially keep the Fed on hold here temporarily, but that is going to be a temporary spike depending on what happens. If Israel and Iran settle issues pretty quickly, oil prices will start to fall again. All right, that's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th. with Ratliff and Roberts at realinvestmentadvice.com. Realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. So a couple things that are coming up right now. One of the issues that is going on at the moment, and we talked about this previously, is this, of course, the Fed meeting today. That'll be the big market mover today. We'll just wait and see what happens. But again, I don't expect much out of that meeting. We may get some volatility around 2 o'clock. The market might spike up or down depending on what Jerome Powell says in terms of, kind of if his tone comes off more hawkish or more dovish, right? Does he kind of start to shift his tone a bit to say, hey, we're seeing the employment slow down. We're seeing inflation coming down closer to our target. So we're more inclined here to cut rates. Or is he going to take the more hawkish stance because he's kind of at odds with this administration saying, hey, everything's fine right now. Employment's strong. We're not going to be cutting rates. So how his tone comes off will be what actually moves the markets this afternoon up or down. And we'll see how that happens. Of course, as I noted, at the same time, we have this whole deal with Iran and Israel going on, which is weighing on market sentiment a bit. But, surprisingly, it's not been a lot. Investor sentiment remains extremely bullish right now. Retail investors are chasing penny stocks at a rate we haven't seen since 2022. 2020. You got a lot of speculation. You remember the whole AI is dead story. That's now over with, and all those narratives about tariffs are going to cause a recession. That's over with. The debt and deficit narrative, that's dead, moved on. The market is continuing to find reasons to rally, and that's very typical of a bull rally stage where investor sentiment and positioning is kind of in the middle of its range. And, we're not extremely bearish. We're not extremely bullish. We're kind of the middle. As we talked about before, is that when that is the case, we're typically in a period where the herd, right, is right. And right now the herd is right. And so they've got a lot of momentum, a lot of strength behind this, lifting markets. So again, market's always kind of searching for, reasons, rationalizations, whatever it is. So always just be careful about whatever the reasons being assigned to a market move one day or the next is. At the end of the day, it comes down to really supply and demand of buyers and sellers. And right now we have a overwhelming demand of buyers. Now, having said that, we are starting to see the market kind of consolidate here a bit. Yesterday the market sold off a bit. Today we're going to open up. And this has kind of been the case. It's, ever since last Friday when this whole outbreak started with Iran and Israel, we were down on Friday because of Iran and Israel. We're up on Monday because of Iran and Israel. We're down on Tuesday. So this has been, kind of the narrative, but the market's just kind of consolidating here. We're not really making any gains. We're not really losing any ground. We're just kind of starting to trade sideways, and that's starting to work off some of that overbought condition that we talked about before. So again, just be a little cautious here, as we've talked about before. Just, hold a little extra cash at the moment. Just manage the risk in your portfolio. Let this kind of situation evolve between Iran and Israel, and we'll just kind of navigate it as we go along. One of the other issues coming up is the big, beautiful bill. Now, you'll remember that just previously that the House passed the big, beautiful bill, and there's a lot of stuff in that. And one of the big concerns is, and of course this was what was leading the whole deficit narrative and everything else, is that it would raise the debt ceiling and increase the debt in the U.S. And this was, a big pushback by the media, against the administration because, they didn't like this big, beautiful bill. But it does codify the tax cuts. The Tax Cut and Jobs Act of 2017 gets codified in this big, beautiful bill, makes it permanent, along with a lot of other stuff that they've got embedded in there, like no tax on tips, no tax on Social Security, some other stuff. Well, remember that bill only passed the House by one vote, and it took a good bit of negotiation to get that bill passed through the House with just one vote. Now it goes to the Senate, and as we talked about before, the big problem here is there's two things. First, there are some items in that bill that cannot be passed as is through the Senate because of the Byrd rule. The second is that if the Senate makes any changes at all, it has to go back to the House for another vote. And this is the reconciliation process. So if it goes back and they lose one vote in the House, bill doesn't pass. So what we said previously is there's a big risk that this bill does not pass the Senate. Now, what we've seen over the last couple of days is we're starting to see a few senators starting to stand up and express concerns. And we're talking about conservative Republican senators expressing concerns about the debt and the deficit and the raising the debt ceiling. And there's a couple of senators out there saying, hey, we're not going to vote for it unless we don't raise the debt ceiling. Okay, so there's some problems that are brewing, and there's only a 3-vote margin in the Senate. They can afford to lose 2 votes. They can't afford to lose really more than 3 to get this passed in the Senate. And so so the point here is that there's a lot of eyes focusing on this big, beautiful bill. There's a more than a 50-50 chance that bill's not going to pass in its current form.
Yeah, I think there's going to be a lot of change. If you think about the Byrd rule, that only goes to actual, budgetary items. So it should exclude any non-budgetary items within this.
Right.
And the big concern, you mentioned one thing at the very beginning, was essentially what the thought is or the sentiment surrounding the, raising the debt ceiling. The debt ceiling's raised every year. It's like, oh, this is such a terrible bill and it's going to raise the debt ceiling. Guess what? They're going to have to do that in a couple months anyways. Yep. So they're just trying to get ahead of that. And I'm not a big fan of it. I know there's a lot of people frustrated out there. There's a ton of fatigue in the sense of, many people thought Doge was going to come in and just do all these sweeping cuts that have yet to be done because of circuit court judges, all these people stepping in and not allowing some of these issues to be actually, to be looked at and to actually make some headway on it. So it's extremely frustrating. But I do think, one thing we've gotten a lot of questions on, Lance, and this last weekend we had our retirement income event in the Woodlands here in Texas. And there were a lot of questions around, what do these bills look like? What are the odds of things getting done? And I said, you know what? And we said this on air, I don't want to spend a ton of time on this because it's likely to change. And we're seeing some of that now, right? The big thing on this, I think, is what you just mentioned, is that it does make the Tax Cuts and Jobs Act taxes permanent, right? No sunset. Those sunset at the very end of this year if nothing is done. There's a very slim majority. And with reconciliation, meaning that the Senate does, assuming they pass a bill, it's going to go back to the House, and they're probably going to they're going to cut it up all over again, and they're going to send it back. And this is going to be, number one, timely. Number two, there's going to be a lot of issues surrounding this because there are non-negotiables that each side say. And I'm not talking about Republicans and Democrats. I'm talking about Senate Republicans and House Republicans.
Yeah.
I mean, there are some issues that they find.
You've got the Freedom Caucus, which is, very much against increasing debts and deficits. So, and this is a mistake, and I said this before, I thought it was a mistake for him to try to do one big, beautiful bill. Mm-hmm. There were some easy gains to get very quickly. In other words, just pass a bill to make the Tax Cuts and Jobs Act permanent, because
Correct.
Republicans want the tax cuts. Democrats don't want to cause a tax increase, right? And especially coming up in the midterm. So again, so if the bill expires at the end of this year, tax rates go back up. They go back up starting January the 1st, which is going to be just 9 months before we get into the midterm election cycle, right? So Democrats aren't going to want that on their plate. So there was an easy give me to just come in and say, hey, we're going to extend the Tax Cuts and Jobs Act, make it permanent. That bill would have passed pretty quickly.
Well, that's what drives me crazy. Every time Democrats come out with this huge bill, right? Thousands and thousands of pages, Republicans swear they're going to start putting bills through that are going to be like 10 pages or less. And yet it's never happened.
Right. The first bill they do is like 2,000 pages. So
yeah, Richard actually went through the bill, line item by line item, and then he went back and had like Grok do it, like Chat GPT.
Right.
And he's like, that was the dumbest thing I've ever done. It came back with 11 pages. I'm not sure why I just didn't send this through this instead of spending all of this time. But we want to get an understanding as far as what it means to clients, what it looks like. And even then, that may not have been as fruitful as we once thought, because it's going to change anyway.
Exactly.
You almost just need to wait and say, all right, well, now we know. And then the problem is they're going to pass a bill. Then all the attorneys have to figure out, how do they enforce it? What does it actually mean? Just like any of these tax bills that, some of them we're still waiting on from years. Like, how do you take your RMDs? That was something that we waited on forever for inherited IRAs. So there are some other big ticket items in here. And obviously you mentioned the overtime and tax on tips. Yep. There is probably a bit of a misconception surrounding that. That is only deductible up to $25,000. So still reportable, but deductible. Up to $25,000 and only through 2028. So it's not a permanent, item within this bill.
Right.
And I think that's something that, we continue to hear everybody talk about. Oh, no tax on overtime and tips. While yes, I think that's great. That should put money back into the economy. And I'd much rather you guys spend it than the government, because Lord knows we know what they do with it. Not good. But another one is auto loan interest is deductible up to $10,000 as well. So that's a good caveat there that I think is something that will likely get done. But, one of the things that we continue to hear about is Medicaid funding being cut. So this is only for states that have actually increased their tax over the years on Medicaid. And so essentially, the big talk is, oh my gosh, Medicaid's it's going to be underfunded. It's not going to be performing the way it should. And really what this is about is, if you actually look underneath the sheets here, there's a lot more going on, and states are gaming the federal government to get more money from them.
Right.
So we can talk about a little bit more on that and the rest of this bill.
All right. Come back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Impossible Foods sets its sight on flexitarians. I qualify as a flexitarian because once in a while I have a salad.
The Real Investment Show podcast.
Is that what it's considered now? They made up a word for this?
Yes.
Those are perfect names because Beyond Meat, yes, it's not meat. And Impossible
Foods.
Yeah, it is
It's
impossible.
impossible to eat.
Same show, your schedule.
Can you imagine sitting around the boardroom at Impossible going, okay, what do we call people that eat a salad every now and then? I have an idea. Occasional-tarians. No, that doesn't work. It's too long. How about flexitarians? God, that's it. We're going with it. Flexitarian.
That guy got a raise. Isn't that
He did.
crazy?
He got a raise for it.
That's genius.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about the big, beautiful bill. This is kind of up against the wall now, needing to get this passed. Of course, if it doesn't get passed in the Senate, then it has to go back to the House. And this is very likely going to be the process. There's going to be changes made. It's going to go back to the House. And my estimation is, and again, just a wild guess, is that there's going to be some hangups in the House once it gets back down there again. We'll see what happens at that point. But we were just talking a little bit about changes to, kind of the no tax on tips. That's going to be, again, as with most of these things are, even with the Tax Cuts and Jobs Act, it was all set to sunset, right? We never pass, these things are never passed on a permanent basis. Like, hey, we're going to pass this bill. It's no tax on tips ever again, right? It's no tax on Social Security ever again. It's always, we're going to pass this for 2 years. And so, it gets the administration a bit of, credit near term, but it expires before the next election. So
there's some goodwill in there.
Yeah, exactly. That's all it is. But anyway, so you were just talking about that. And then, of course, Medicare is one of the big issues. Been lots of concern about, this bill is going to gut Medicare. It's going to take away Medicare.
More specifically.
Medicaid, sorry. It's going to take away Medicaid from people that need it. And, and there's a kind of a lot of misnomers relative to some of the media headlines, and particularly if you read more of the, the CNBCs of the world or the Market Watch of the world. It's like, they're going to gut Medicare. That's really not the case here.
Medicaid.
Well, no, you actually no.
Well,
It is Medicaid, but if you read the headlines, it's Medicare.
Well, so number one, Medicaid is going to be state driven. Medicare is going to be more universal in nature, with the exception of a couple of states. And so, Medicare is your alphabet soup of health insurance. That's your A, hospitalization. B is going to be your preventative care, lab visits, doctor visits, things of that nature. D is going to be prescription coverage. And historically, that's for people over 65 or on disability. And Medicaid, more specifically, is going to be for those more impoverished, right? You don't have much in income, don't have much in assets, that really need the help. And so this is where I think that a lot of people get hung up on this, is that, oh my goodness, Medicaid's going to go away. Well, Medicaid is a state-driven system that does get federal funding. And so the Medicaid aspect of things is where I think there's a lot of frustration and there is a lot of hang up, and you're seeing much more of a conversation, because this bill more specifically addresses that. But the legislation right now would effectively cap provider taxes at 3.5% by 2031, down from the current 6%. So everybody's like, oh my gosh, this is terrible. We're not going to have the funding necessary to help those that are in need. And this is only for states that expanded Medicaid under the Affordable Care Act. And that cap would be phased in by lowering 0.5% annually starting in 2027. So it's not a rip the Band-Aid off type situation. But what they found is a lot of these states were, as they've increased taxes, they've been able to actually kind of game the system a little bit with the federal government. And so when you look at the numbers, there can be some actual good argument to say, hey, let's make this more universal. Let's have all states at the same level. And then, kind of back into the numbers from there.
Yeah,
so
just to prove my point, here's a headline from Market Watch.
Kind of game the system a little bit with the federal government.
Almost read it without
and
seeing
so
Really?
when you look at the numbers,
It's right there.
There
You actually can't read it because it's right there. Current public tax bill will cut $500 billion
say,
from
hey,
Medicare.
let's make this more
the
universal.
bill just gets
let's
more
have
and
all
more
states
cruel.
at the same level, and then kind
So
of back
as I said,
Yeah.
you're correct. It is Medicaid. The headlines from the media are about gutting Medicare.
Well, and the question with Medicare is, and so that goes even further, right? So you have the Old Age Survivors Disability and Trust, right? And so it is that is significantly underfunded. And when you talk about Social Security, no taxation on Social Security, you look at all the other things that potentially do occur, well, then that can pull funds essentially from the trust, right? So right now we can go to 2033, 2034 without a reduction in benefits. And that'll actually be a little bit quicker, assuming this scenario. So there's a lot of moving parts here. And I think that that's a bill that needs to be addressed separately. And so we're going to need to spend time on this. And this is extremely frustrating. Small things can be done, small tweaks. Now, it's not exactly a very votable bill, right? You're going to upset somebody. Some part of the population is going to be upset. If you think back to the 1980s, last time major Social Security reform has been done, you increase the full retirement age from 66 to 67. If you're born between 55 and 59, you added 2 months to that 66 number for full retirement age. You could see them increase that. We could see them eliminate the income limitations for how much is taxed for Social Security. Right now that number is give or take around, just over $176,000. So those are things that need to be addressed. Will they be addressed in this bill? Highly doubtful. Because it does, especially going into a midterm election, it's just not something that most people are going to want to put on their resume saying, hey, we just did this. But the Medicaid eligibility is something that I think is great. If you can work, right? The House bill imposes work requirements on Medicaid beneficiaries beginning at 19 years old. But the Senate version says adults with dependent children older than 14 will also have to prove they work, attend school, or do community service for 80 hours each month. And I think that making people less reliant on the government and productive members of society, I'm all for that.
Yeah. No, I don't disagree. I mean, there's there's the old story about the Department of Agriculture, which is it's the organization that puts out SNAP benefits for the average American. So if you need supplemental nutrition assistance program, you get that through the Department of Agriculture. They also, in that department, they also oversee the Park and Ranger Service, which says, please don't feed the animals because they become dependent on humans and won't fend for themselves. So, if we're telling animals that they need to fend for themselves so that they are independent and can take care of themselves and not become dependent on humans, maybe just maybe
we need to use that with the two-legged animals.
Yeah, maybe the two-legged animals need that same kind of incentive to become independent. I'm just, this is government at work for you.
Well, no, I think we all need some type of. I'm not opposed to safety
Don't ever
nets.
use that in a clip. No.
What?
He'll get us canceled. That's why.
Two-legged animals. We're all two-legged animals.
Yeah, but no, don't use that for an out clip.
Good Lord, what's wrong with y'all?
I know, but you can't use it. Go ahead, Danny.
Never mind. Keep my mouth shut here. I'm not sure where you guys were going with that, but I'm pretty sure everybody understood.
All we're saying
we're
is
gonna
that everybody's
going
so sensitive these days. It's just we don't want to get canceled before we actually
whatever.
Don't want to hurt anybody's feelings.
Okay, I'm done.
All right, are you sure? Okay.
No, so
I was hoping you were.
Oh yeah, let's talk about what may or may not happen today in the markets. Just like yesterday.
Okay.
No. So one of the bigger last things is the salt, right? So a big aspect of this is right now the salt bill has been at $10,000 for deductions on state and local taxes, and that's been a very big pain point for especially politicians on the East and West Coast, that you can't deduct as much as what they used to be able to do from an itemization perspective. But it's also a big reason why you saw the standard deduction go up quite a bit. And so that's been a pain point. And the Republicans actually passed a bill that would say you could deduct up to $40,000 annually as long as you're making under $500,000, right? And everybody says, okay, well, how many people does that actually impact? But the Senate bill says they would like to permanently extend the $10,000 cap, which is scheduled to expire this year. And really, Senate Majority Leader John Thune said that this is essentially a marker to go back and debate with House Republicans. And Rep. Mike Lawler out of New York, also a Republican, says this bill is dead on arrival. A $40,000 deduction cap is the deal, and he will not accept a penny less. Now, they're all bartering for the best deal. It's all negotiation tactics. But this is just one example of many that I think that we're going to see go back and forth. So, Lance, you mentioned this bill. Let's say it does pass the Senate. It goes back to the House. Then it goes back to the Senate once again. There's going to be a lot of changes from here to there. As we get a little bit more clarity surrounding it, we'll give you guys what this looks like, and then hopefully we'll get something done. I think the big thing here is the tax cuts. And that is the one question I think many have. Is that what does that look like? And, we can begin to plan a little bit better from a distribution perspective. How should you be doing Roth conversions? Do we need to be thinking about this tax code actually expiring? Because at the moment, we're kind of stuck in limbo just waiting to see exactly what happens.
Yeah. So what's your prediction? What's the outlook?
I think they get something done, especially with the, making the tax code permanent. All the other stuff's just on the, that's kind of on the peripheral, right? It's on the edges. And essentially, something will get done here. It'll probably be somewhere in the middle. It's not going to be easy. Like you mentioned, the majority is so slim, right? You don't have a whole lot of options for people to dissent. Right. And so going into an election year for midterms, I think they have to get something done, because if not, we've had a whole lot of words and very little action.
Well, I guess, and what does this mean for kind of for the markets too, if it doesn't get passed? Because there's a lot of bank on this keeping tax cuts low, right? Keeping these tax cuts in place. And there's some real risk to the markets if that doesn't get done. And if the Tax Cuts and Jobs Act does revert, that's going to have a big impact to corporate profitability and earnings. So there's more riding on this than just, worrying about Medicare and Medicaid. There's a lot that's going to be riding on outcomes for the markets.
The one thing is, do we actually see corporate tax cuts? When does that come?
Exactly. All right, quick break, come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So one of the big questions that we get all the time is with individuals that come in, they say, okay, I'm ready to retire. And, you know, this is always kind of the interesting point. And they say, well, you know, I've saved up $1 million in my, and this is, you know, we've talked about this on the show before too, is that you see all these articles written by MarketWatch or CNBC, whatever. And it's like, hey, how to become a millionaire. You know, if you start at 25 and you put in $500 a month in your investment account and it grows at 12% a year, you'll be a millionaire by the time you're 55, you know, whatever the number is. But, you know, two things are grossly wrong with that point of view. First of all, markets don't return 12% a year. This year is a good example of that. And secondly, that $1 million at the age of 25 and $1 million at the age of 55 are two very, very different things because of inflation and cost of living, et cetera, needs, et cetera. So being a millionaire, for instance, when I was growing up in the 1910s.
During Hurricane Carla.
Exactly.
How old were you then? Were you like 70?
I was 63 when Hurricane Carla hit. So, but back in 1980, $1 million would invested in treasuries would generate roughly about $120,000 a year to live on. The average cost of living at that time frame was about $25,000 a year. So $1 million would do well to sustain you in retirement. $1 million today is honestly not that much money. You put $1 million into treasuries today, you get $50,000 a year. The average, the basic living kind of median income in the U.S. right now is about $75,000 a year, $75,000 a year. The average cost of living runs right around $70,000 a year. So, you know, $1 million doesn't provide you the same lifestyle that you had back in 1980. And that's because of inflation, cost of living, and everything else that goes with that. So, you know, we need to make, when people start talking about retiring, you have to adjust for what, you know, things you're going to be in the future. And so you have to calculate for inflation, calculate for living standard changes, all those type of things. But it's always interesting because we'll get people that come in and say, I'm ready to retire. and I've got $1 million in the bank, and I just need $2,000 a month to live on. And then you start digging into their monthly income and expenses, and they're spending $10,000 a month, right? There's just not going to happen. But, again, these are some of the issues. And there was an article in Market Watch. Lady, she says, I'm 48. I want to retire next year. So she wants to retire at 49. Do I have enough money to last me until I'm 98? She has 2 homes, one that she lives in. They're paid off. One she lives in and one is empty. So she's not renting it out. I'm presuming that probably at some point.
It's not rented out yet.
Yeah,
correct.
Yeah. But I'm, at some point, it seems like she would rent it out.
You would think.
For income, right?
Yep.
And then she has about $1.2 million in the bank, give or take, in terms of investment accounts, et cetera. So the question is, could she retire and not outlive her money?
Yeah. And I thought this was a great kind of example because we do get this question quite a bit, and it's really going to be dependent on a number of things. And so she was basically asking, she wrote in and said, hey, I make $400,000 a year. I'm 48 years old. I have 2 homes at $750,000 that are fully paid off, which I don't want to include in my retirement scenario, right? So non-producing asset, and it's going to be costly over time. Is one thing I think of right off the top of my head. Saved $636,000 in 401ks and IRAs, $326,000 taxable investment account.
Yeah, I got that $1.2 million. Yeah,
well, yeah, I know. I get it. No, but
point.
People need to understand exactly because it's going to paint a picture of where I'm about to go.
Okay.
So
you're running out of time is the problem.
Hold your horses, buddy. So stocks, individual company stocks, $200,000, cash savings of $110,000. And so she also owns 2 homes in a foreign country, but does not want to include any of these other assets in here. So we have to assume to plan for at least 50 years. And she only needs $5,000 each month, which I can't make that math, if you know what I mean. Like It doesn't make sense. If you own 4 homes, those are going to be costly assets. So you think about property taxes, insurance, maintenance on 4 different properties. How are you going to do that on $5,000 a month?
Well,
right?
that right there is the flaw with all of these financial plans.
Correct.
That I see is that 2 things. First of all, they run these Monte Carlo simulations and then take the average return of those Monte Carlos and say, well, if you just get the average return over time, and again, we compound returns, that's going to give you a much better outlook than reality. Again, if you had started your retirement in 2000,
correct,
your retirement plan did not work, period. The second thing is that this assumes that she's going to spend $5,000 a year this year in expenses and $5,000 a year until she's 98. And that's not going to be true because it's not adjusting for inflation.
Well, we don't know that. We don't know if they're adjusting for inflation or not. It doesn't sound like it is.
It says if I keep my expenses at $5,000 per month and take Social Security at 62 in the simulation.
In 10 years, she's in trouble, right?
Exactly.
Yeah. And so while, albeit we don't see people give themselves a raise each and every year from an inflation perspective, we do assume that you do inside of a financial plan. Now, historically, every several years, we talk to people and say, yeah, you know what? That money's just not going as far. Let's go ahead and give ourselves a little bit of a boost. But this also, we don't know what type of internal rate of return that they're utilizing. I'm assuming this has to be extremely high for this to work because you've got to think about we didn't think about contingency plans for emergencies. We didn't think about all those additional expenses within this. And so this is where it's kind of tough to make the rubber meet the road in the sense that how are you going to do this and not liquidate any of these assets over time? Because if you're taking Social Security at 62 and you've stopped putting in at 49, you have to remember Social Security looks back over the highest 35 years. So they're not going to be fully funded into it and they're going to lock in a discount. So that Social Security, which if she continued to work, making $400,000 a year would be pretty darn high. It's not likely going to be nearly as high because she's going to retire early. And I get it. She's talking about, hey, I face burnout. I'm tired. I've been doing this for a long time. But at the end of the day.
I know when people say I'm burned out and tired at 48, I'm going, I have no sympathy for you.
None whatsoever. But that's where I think some of these plans are a little bit disingenuous in the sense that, yeah, we can make any of these things look great. Sure, you can retire 12% every single year. And you hear that, and I see that. And in fact, last big market decline, like 2022, not the most recent one, we had a lot of clients who were saying, hey, can you talk to my brother or my sister or my coworker? Their plan doesn't work. And we would look at the plans, and it would assume exactly that. No inflation, high returns, never any dips within the markets. And sure, it looks great, but what happens is the one time you get a large dip or those return requirements aren't met, the whole thing's blown up.
Right.
And that's what I feel like when somebody reads this, they think, oh man, this lady has $1.28 million, 1.2, 1.3. Mm-hmm. Great. You know what? I could do that. Well, maybe, but think about all the other things. And what type of health insurance is she going to get, right? That's one of the biggest expenses that we see for somebody before they go into Medicare. So we were talking about Medicare earlier. We do like Medicare, okay? We're not saying it's a bad thing by any stretch of the imagination. In fact, it's a great thing. But that's what Lance was giving me a hard time about. No, we don't want it to be cut. But essentially, we're finding for a couple, they're spending between $18,000 and $30,000 every year, give or take, on health insurance before they reach Medicare age. So, we're looking at $9,000 to $15,000 for an individual, unless you go get on, one of the shared plans or something else.
Well, that was also too, not in this, is that she works as a director for a tech company who's paying for her health insurance. When she leaves there, she's going to have to pay for this insurance.
Correct.
And everything else. And then it was also interesting, if you read down further into this article, it talks about, well, what happens if you have a medical emergency? What happens if, there's all these unknowns that happen.
Correct.
That can really derail your financial plan. Everything looks great on paper. And that's the problem with all this stuff, is it looks great on paper. And remember, there was that whole FIRE movement that was occurring for a while, financial independence, retire early, and all these kids were bailing out to go live down the river down by the river in a van.
Oh, yeah.
And when the market started to underperform, all those plans went AWOL. And they tried to come back into the workforce, but they'd been out of the workforce for so long, all their skill sets, their certifications, et cetera, had become outdated. And all of a sudden, they couldn't get the same job back that they had before because they'd been out of the workforce for too long.
Well, technology's changed so quickly, where years ago it probably wouldn't have been nearly as big of a deal. But yeah, that FIRE movement's gotten awfully quiet.
Yeah.
It's a big difference when you get a little bit of volatility in the market.
Well, even the guy that started the FIRE movement has gone back to work.
No way.
So, yeah. Financial Samurai, whatever his name is.
I don't know.
Yeah.
But that is interesting, because we talk about that often, and we talk about the crossover risk and the challenge that many people have when they go from meeting deadlines, a sense of purpose at work, to not having any of that, or not having a plan. And I think that's a struggle for a lot of retirees. And I get the want to do that at a younger age. Say, listen, we can enjoy it now. We're in good health, but the world passes you by pretty quick in this day and age. So, that's one of the things that I think is very interesting, that now these people are having a challenge getting a job again. But, good for them. They're able to get a couple years on a tropical island or wherever they may have been. And
but you pay the price when you come back.
Yeah.
And again, there's challenge. And the whole point about this is that there's big risks that you take whenever you drop out of the workforce, retire too soon, whatever it is that you've got to really make sure, and this is where you go back to the financial vulnerability cushion, other stuff, is to make sure that you've got enough money set aside somewhere that in the event that something goes haywire with your plan, you're still okay.
Yeah.
And that's the real part of financial planning that you need to work on, is insert a whole lot of things into your financial plan that are worst possible outcomes and see if you still survive. Because the plans you get normally from your kind of run-of-the-mill, advisor, those are the most optimistic outcomes. There's a whole lot of stuff that can happen that derails that outcome.
Absolutely. Got to meet somewhere in the middle.
Exactly. All right. Wraps up the show for the day. Thank goodness. We'll be back on Monday. Financial Fitness Friday with, you here Friday?
No.
With Richard?
Nope.
Well, you're not doing Fridays anymore?
Nope.
You just quit?
I'm trying to.
Okay.
You're trying to retire
early?
Fridays.
You're trying to retire early?
Yeah.
All right. I'm retiring with you.
Yeah.
All right. Anyway, Richard Rosso here on Friday Financial Fitness. Be back on Monday. Have a great weekend.